Good day, I'm Trend Boy Analysis and you are watching another tutorial video from Currency Articles. Today we'll be discussing another friend of mine, well, a very good tool. Actually, it's so famously used almost every trader uses it. It is called the Relative Strength Index, RSI in short. And for those of you who don't know what the Relative Strength Index is, it is right there, written in plain bold, Relative Strength Index. Okay, so what is the relative strength index and how does it help us trade? Well, the relative strength index is quite simple. Sorry, excuse me for a bit. Just want to show you this whole chart. There we go. Relative strength index is actually a simple tool to use. What it does is it shows us bull power and bearish power. First of all, we want to know whether we should buy or sell, and depending on the power or the strength of buyers, that helps us buy a certain asset or currency pair, and whether we should sell a currency pair, looking at the relative strength index. So the relative strength index, first of all, has three levels that you should always look out for. It's 30, 50, and 70. So what everybody else will tell you is that if it's at 50, it is neutral. And I'm telling you that today. When the relative strength index is at 50, it is neutral, meaning both buyers and sellers are really battling to push price to either side. Either the price could go up or it could go down. It depends exactly where the other side will rest. Okay, so that's 50. Above 50, we have 60. When the relative strength index reaches 60, that means a rally occurs. Okay, always watch for this. Okay, look at this. First time here, we're looking at a 30-minute chart, US dollar versus the Swiss franc. So it's a 30-minute chart. I wanted you guys to see that, so as you can see exactly how simple this is. So here we have it. Relative strength index passes the 50 level. As soon as it bridges the 50 level to your 60 levels, 57, 60, this rally, very quick rally here. It was very brief, but hey, if you bought that in that brief space of time, it's like 1 hour because these candlesticks close for 30 minutes. It's a 30-minute time frame, so you see that within an hour you could have made yourself a good number of pips. So a relative strength index also has a level that is called overbought. When it's overbought, it is above 70. Let's see if we can find it here, shall we? Okay, we approaching overbought levels. So let's find overbought. Here we are. Yes, overbought. Relative strength index was above 70, 73. If you're looking at the right side of my screen, 73.737. So as soon as it went above 73, obviously you have to look at why traders sold. That could have been a resistance level right there because it was going up. You'll have to use multiple time frame analysis too. We also teach that. Please watch other videos from us. So relative strength index went above 70 to 73. This means it was overbought, and that means the sellers are no more in the game. There's a lot of buyers are out of the game. There are no more buyers, which means there are only sellers left, and sellers took advantage of that. So they took the Swiss franc versus the US dollar from 0.979 all the way down to 0.946. Guys, that is a whole number of pips, okay? That is a whole number of pips. It's nearly 300 pips if you're counting that. Meaning with $50, you could have made $300 on that trade alone, okay? So we also have what we call oversold. Now in economics, if you did economics in class in high school or you did it in varsity, your tertiary levels, we have what we call a peak, a recession, a recovery, and a trough. So a trough is when the economy is really struggling to, get up from whatever crisis they may be facing. The trade balance is not looking good. The trade balance is at a deficit. So the economists really have to do something about it. And therefore, it starts recovering again, and there's a peak, and there's a recession again, trough, recovery, and so on. Just like that, the relative strength index is living proof that nothing rises or falls indefinitely. At some point, it has to end. And when it ends, things start picking up again. And if they pick up, if things are too good, obviously that means something is the currency is too expensive. I mean, if the dollar is too expensive, people probably don't want to buy anything from the US because it's too expensive. We can't actually import from the US. So the relative strength index is living proof that economics really is at play when it comes to trading. So here we have below 30, we have 20.04. That means that's as low as it got, US dollar versus Swiss franc. So we have a recovery phase again. Here we are at 50, 60, and a rally. So that's basically what you should know about the relative strength index so far. 50, above 50, buy. Below 50, sell. Below 30, stop selling. Above 70, stop buying. So there's something else we want to turn your attention to. It's called a divergence, dear friends. So we'll find this divergence, what a divergence really is. Okay, so I think I saw this on my hour chart. Okay, 2-hour chart. A divergence is when market price is creating higher highs. As you can see, the oscillators have to be hand in hand with that to support that this bullish price that you see here is actually continuing. This is confirmation. Okay, when you see higher highs in market price, okay, and higher highs with your oscillators, it's confirmation. Now the moment you start seeing higher highs and lower lows, lower highs actually, see that? It's creating lower lows, lower lows. You can actually put a trend line. If you watched our lesson about trend lines, to confirm this, you can actually put trend lines on a relative strength index. Who knew? Well, you do now. So here we go. When you see higher highs and lower lows like that, there's a high chance that this trend will reverse. Okay, meaning one thing here, it could become overbought, and as soon as it becomes overbought, this does not mean you should start selling because the trend may reverse. Of course, if it becomes overbought, then above 70 and you start seeing it fall below 70 from that above 70 peak to below 70, that should be confirmation that that trend is reversing. You may look to sell there. And yeah, that's basically it for the relative strength index and trading a divergence. The same is also true with having lower lows, for example, and having higher highs. So look at your indicators, guys. Really, look at your charts, look at your time frames. Go out there, look at different charts. Do not say you feel comfortable trading, say, on the 1-hour chart. Okay, for example, look at this. I do not have that divergence on the hour chart. So whenever they tell you to get a bird's eye view on the market, you should actually step back, look at these different time frames, and if you're satisfied with what you see, execute your trades, your buying or selling orders. And whenever you're confused, rather not trade it at all. Okay, there are days to trade and days to play out the market. And this is Trend Boy Analysis saying thanks for watching. Do stay tuned for the wrap up. We'll be including more about the relative strength index. And thanks for watching. To book a free trading lesson, please visit us currency-articles.com or click on the link below to learn more. Thank you.